We could be in triple digits in silver. We're already in triple digits in silver in Shanghai, where silver is trading at over $100 an ounce. Or if gold goes that, it's a $6,000 gold. So if gold goes even higher than that, some people think $7,000, $8,000 gold. So Newmont, which is a bellwether, still has that kind of upside, or four-bagger upside. I mean, the largest gold producer in the world, silver miners will outproduce silver. Newmont significantly in mid-tiers, and juniors will outproduce it. But one way we know that we're early and that, you don't want to miss this rally, if we're right. If the S&P hangs in there and even goes a little higher, gets above 7,000, 7,100, anywhere in there, then gold is going to maintain these levels. 45, 46, maybe even 4,700 in February. In this video, respected market strategists Don Durrett and Rafi Farber examine why the precious metals rally may still be in its early stages, with silver and gold showing explosive upside potential. The discussion begins with a critical observation. Silver has already entered triple-digit pricing in Shanghai, signaling intense physical demand outside Western paper markets. This divergence suggests that global price discovery may be shifting eastward. They explained that if gold stabilizes around $6,000 per ounce or accelerates towards $7,000, silver could follow with dramatic gains, potentially reaching well into triple-digit territory globally. This dynamic also reshapes the outlook for mining equities. Minimane, the world's largest gold producer, is highlighted as a bellwether with multi-bagger potential. Yet, silver miners, especially mid-tier and junior producers, may significantly outperform due to higher leverage to rising silver prices. If momentum continues, gold could challenge the $4,500 to $4,700 range in the near term, reinforcing the idea that investors may still be early in one of the most powerful precious metal cycles in decades. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview. If you look at the fundamentals of gold and silver, they basically, in my opinion, scream that gold's going to trend upward. When the gold's not, the trend is up, not down. And that's not, if you look at the macro that's kind of pushing gold, there really isn't any macro that says gold's going lower, right? You don't see it. So the chances are pretty good, probability-wise, that gold's going to go higher, silver's going to follow, and the multiples are going to expand as the balance sheets improve. And so this is kind of a best-case scenario for investors. So I've been waiting for this for decades. I thought we were going to get it in 2011, 2012, but it didn't happen. It would have happened if the economy wouldn't have came back up, but the Fed, basically, we didn't have inflation back then. So the Fed could take rates to zero, print at will, and basically get the economy back on its feet again. This time it's going to be a lot harder for the Fed. So there's a very good possibility that this bull market kind of has legs here and could go all the way to there's going to be a shortage of silver. There's going to be a shortage because there's just not enough silver for both fabricators, which need about 70%, which need about 700 million ounces a year. It's a lot of silver that's necessary for solar panels, for any type of vehicle, phones, anything electronic. So it's got massive, industrial needs, if you will. All your military is all silver. And you then, once investors say, well, we want some too, at that point, there's not enough. And so silver, once it got above $35 and below 30, and nobody cared about it, there's no interest. Just the small little retail crowd, the silver bugs. There's no interest, really. Once you got above 35, all of a sudden it became a monetary metal. And now the investors are here to buy it. At that point, silver ripped from, 30. It was at 35 in August, early August, and off to the races, went to 40, 50, 60, 70. It's just been going. So we got September, October, November, December, 4 months, 4.5 months. It's went from 35 to 90. It's up 25% in 2 weeks. It ended the year at 70. It's at 90, up 25% in 2 weeks. And the reason why is because there's not enough of it. So we have this big problem with inventory levels. And but silver is going to be uber volatile. You're not going to get a free ride on silver because that's not how it works. So silver is going to be volatile, and I'm going to tell you why it's going to be volatile. There's lots of reasons for silver to get whacked, if you will. The first reason is, and I don't know when it's going to happen this year, but I expect it at some point, is the S&P is going to correct. And the S&P corrects, it'll pull down gold and it'll pull down silver. And silver, back in October, gold corrected 12%, silver corrected 18%, so 50% more. So that's kind of what you can expect. Silver's going to, and this time because silver's outran gold, it will probably correct more than 50% of whatever gold does. But the good news is that gold is so well positioned this year that I don't think we have to worry about more than a 12%. 15% outlier at worst case, but that would be very short-lived. But the more likely scenario is gold only goes down like 8 to 10 this year. And when it does, everybody's going to know this is a buying opportunity. Gold is the new buy the dip asset, and it's going to become very obvious this year, especially how fast this thing bounces. And so if they can't hold gold down, then they can't hold silver down. But so that's the first thing that's going to create volatility in silver. The second thing that's going to create volatility is the shortage. I think the shortage could come as early as March. I've been having these conversations with Grok, and we argue. Grok thinks Grok's more pessimistic than me. Grok thinks that the silver inventory problem is going to happen in Q1. I think it's going to happen in Q2. So we're kind of fighting over it, but I'm hoping Grok's right. In this video, the discussion centers on why the fundamentals behind gold and silver are signaling a powerful continuation of the current bull market. From a macro perspective, there is little evidence suggesting sustained downside pressure on gold. Inflationary forces, expanding balance sheets, and structural monetary stress all point toward higher long-term prices, with silver positioned to follow, often with greater magnitude. As gold trends upward, silver's role expands beyond a neglected asset into a critical monetary and industrial metal. Roughly 70% of annual silver demand comes from fabrication driven by solar panels, electronics, vehicles, and military applications. With global demand approaching hundreds of millions of ounces per year, even a modest increase in investor participation creates a severe supply imbalance. Once silver reclaimed higher price levels, investor interest returned rapidly, accelerating the move. The video explains why volatility is unavoidable. Silver historically amplifies both upside and downside moves relative to gold, especially during equity market corrections. Short-term pullbacks are expected, but they are framed as opportunity rather than risk. Gold is increasingly behaving as a buy-the-dip asset, rebounding quickly from corrections and reinforcing long-term confidence. Let's get into the interview. So if you look at the deliveries historically, the deliveries are like, 15 million ounces, 10 or 15, and at most, even less than that, but at most, you never see it any higher than that. Now we're kind of doubling that and tripling that. And last year, the deliveries last year was, I believe, 90,000 contracts. That's 450 million ounces. That's more silver than is currently on the comics and for March. So they have what they call these major delivery months. So, and the first really major month of the year is March. Normally January and February are not big months, but this is an unusual January. Deliveries, this is going to be around 20 million ounces. So we get 20 million in January. We're looking at 50 million plus in March. That's a lot of silver delivery. And so everybody knows that it's coming. And so last year we had 200 million, approximately 200 million ounces of a deficit. So in other words, investors, it was all investors, right? Supplies about 800 million ounces. That's plenty for fabricators. That's plenty. And so we didn't have a deficit for the fabricators. The deficit is all investors. It's all investors, right? We had 200 million deficit last year. So the supply is around 800 million production, 200 million recycling, and then deficit of 200 million ounces, which came all out of inventory. So we have the last 3 years, I think that the deficit 600 million ounces for last 4 years. 600 million ounces. This year, 2026, it's estimated that the deficit is going to be 300. So it's going to be somewhere between 250 and 300 million ounces of silver that has to come from above ground inventories. There's not very much left after 600 million ounces over the last 4 years. So this is the reason why Grok is so pessimistic about Q4. In this video, the focus shifts to a critical development that rarely gets mainstream attention: the historic surge in physical silver deliveries and what it signals for the market ahead. Traditionally, comics deliveries averaged only 10 to 15 million ounces during even the strongest periods. Today, that pattern has been completely broken. Recent data shows deliveries doubling and even tripling historical norms, pointing to a structural change in how silver is being demanded. The discussion explains that last year alone saw roughly 450 million ounces worth of silver contracts stand for delivery, more metal than is currently registered on COMEX. What makes this even more alarming is the timing. March, typically the first major delivery month of the year, is projected to see over 50 million ounces demanded following an already unusually strong January. This front-loaded pressure suggests that large players are positioning early, not waiting for later months. The real issue, however, is not fabrication demand. Mine supply and recycling remain sufficient for industrial use. The deficit is almost entirely investor-driven. Over the last 4 years, more than 600 million ounces have been pulled from above-ground inventories. Looking ahead, projections for 2026 suggest another 250 to 300 million ounce shortfall, metal that simply may not exist in accessible form. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.